Hi, everyone. My name is Justina, and I'm from Bloomberg. I guess I'm a journalist, so today I was on Twitter, and then I realized that in the context of crypto ETFs, everyone was talking about only one thing. And so I'm going to scramble the script a little bit here, because today when I was on Twitter, everyone was talking about how it seems like the price of Bitcoin has fallen below the cost basis of a lot of ETF holders. Now, according to Bloomberg research, it seems like the cost basis was $82,000. And of course, I think today it's kind of below $70,000. And so maybe if we kind of start here, we've had like crypto ETFs in the US for 2 years now. I mean, are ETF holders like the weak hand or the diamond hand of the crypto market?
I'm happy to start on this question. So, by way of introduction, I'm Dovile Silenskyte, and I work for WisdomTree here in Europe, responsible for digital asset research. And we, as a company, we have 12 crypto exchange-traded products. 8 of them are single coin, 4 of them are crypto baskets, and over 6-year track record managing these. So I travel all across Europe, and I continuously tell clients, large institutional clients, that what they need to be doing is they need to decide what is the appropriate size of crypto allocation within their portfolios, especially if they manage multi-asset portfolios, decide on what crypto exposure they want to have, and if it's Bitcoin, great. If it's crypto basket, great. It's their choice. Then decide on how frequently they want to rebalance and stick to that. I always tell every single individual or company I talk to, please avoid panic buying or panic selling in crypto. So today we are seeing big market correction, and most investors should not be doing anything. Because if crypto was appropriate for them last week, it remains appropriate for them this week, and it will continue to be appropriate next week.
You want to go ahead? Or?
Yeah, sure. I mean, so from my perspective, actually, what we're seeing in flows is pretty interesting because in the US, there are definitely outflows in crypto ETFs. There have been for the past month, and they're pretty significant. In Europe, on the other hand, we're actually seeing inflows. Now, of course, the cost basis of European ETPs could be very, very different from the cost basis of US ETFs, because in Europe we had ETPs for a very long time. But yeah, it's pretty interesting that American investors are like, it looks like they're selling the weakness, and European investors are buying the dip, actually. Now, of course, it's hard to translate flows to actual buy and sell pressure because there may be delta neutral investors putting on the basis trading, buying ETFs and selling futures or vice versa. So it's not as straightforward as that, but it's an interesting thing that we're seeing.
Look, episodes of volatility aren't new in Bitcoin. We've seen that in the past. And I don't have a crystal ball, but there's a chance we could see that in the future as well. And we are seeing one right now. I think it's important to sort of understand why investors, professional investors at a broader level, look at products that we sort of launch. So from a Blackrock perspective, we launch access products. And ETFs sort of continue to be almost this turnkey, efficient product through which investors access the asset. Ultimately, it really depends on the asset demand at that point in time, whether they want to continue having the exposure or not. So to your point, like whatever you've been seeing on social media in terms of the price, I think what's a useful metric to see is like through this period of volatility, what has been the net sort of outflow cumulatively from ETFs as well. I don't have the number off the top of my head, but you will realize that that number may not be a reflection of what's actually happening in the market. So that's useful to sort of see as well.
I mean, if we kind of go back to happier times, like 2 years ago, kind of when I think the launch of spot crypto ETFs in the US was kind of heralded as a groundbreaking moment. I'm sure a lot of my colleagues wrote those headlines too. I mean, kind of how has the ETF wrapper made a difference for kind of institutional adoption of crypto?
So it makes access to crypto simple. institutional investors, they already have equity ETFs, they have fixed income ETFs, they may have commodity ETFs, they have performance, risk, compliance systems that manage their investments and maybe help them produce reports. So adding crypto in the ETP format, exchange traded product format, is easy for them. It sits alongside their other investments and it plugs in easily into the other systems. And also, investing via ETP wrapper removes any need to worry about custody, to worry about key management, to worry about wallet management, to worry about maintaining the proper security, because all of that is outsourced to professionals, which is essential for institutional investors.
Yeah, if I can add on top of that. So I'm Niccolò Bardoscia. I run digital assets trading and investments at Intesa SanPaolo. Intesa is one of the largest banks in Europe. And my job is to invest in crypto, in digital assets more broadly. And we do this with investing in ETFs and ETPs, but also investing in spot crypto. Last year, we were one of the first banks in Europe to put Bitcoin on the balance sheet. So we have seen both, like how easy it is to just buy an ETF and how hard it is to actually get into spots. Because the way it works for a regulated bank like us, when we want to get into a new product, start trading a new product, usually there is a trader who asks, files a request, an internal request to trade a new product, and then every single part of the bank can say, like how we can get there to trade that product. And so compliance, legal, fiscal, accounting, tech, like everybody gets to say like what's needed to get there. And of course, to get into spots, you need to change the concept of custody. You need to change the legal framework because it's not MiFID, it's a MiCAR, which is different. You need to change the accounting rules. You need to change the processes. You need to sign an on-chain transaction, which is actually something that the bank has never done. So it means building an entire framework of new things that everybody within the bank needs to do. And it took us 2 years to get there. It's a very long time. I know banks are not the fastest animal out there, but it's very important for banks to actually not stop at just the ETF, but do those extra steps and get into crypto, the asset, and the technology as well. Because that's what's going to be important for banks and financial institutions in order to use this new technology to build better products which are faster, cheaper, safer for clients.
I mean, speaking of big banks, yeah, we have kind of Nadine here from Citi. Like, kind of, what's the role kind of you're playing in crypto ETFs?
So I lead digital assets for Citi's investor services business. So for the benefit of everyone in the room, that covers our custody, funds, and execution services business. So we've been looking at developing custody capabilities for some time, and that's accelerating with some of the changes in the US market. But I would just echo the point that I think the ETFs are a good access product because you don't have to change how you buy that security today. So we've already seen institutional investors, being one of the largest global custodians in the world, buying those ETF products like they would any other ETF and getting exposure to crypto. And I think I would agree that you do want at some point the direct access, and we're developing those capabilities to act as a custodian for those institutional investors that want that direct access. But I do think it's allowing the institutions to come in as an access product.
And we kind of look at, the trends in the US crypto ETF market. I mean, something like BlackRock's IBIT has attracted such strong inflows. I think it's like a $60 billion product now. And in Europe, we've had crypto ETPs for much longer, but the products are generally a lot smaller. What kind of accounts for that? Like Nikhil, for instance, are you guys disappointed in like the kind of the relative inflows in Europe?
I would sort of attribute the difference between the flows in US and Europe to the market structure itself. So if you look at the traditional markets as well, some of the points were made, so I'm not going to repeat it in terms of why ETFs as a structure is sort of efficient, turnkey for investors to get access. Where it sort of helps is from a portfolio perspective, the way advisors, wealth, etc. look at ETFs is one, you can look at ETFs from a whole of portfolio lens. So you can basically look at it along with your brokerage accounts, and you don't need to have almost disparate ways by which you look at stocks, equities, and ETFs. They also look at it from a risk management perspective, where you can sort of put it through the same operating model, risk management, through a familiar structure, trusted structure. That is why, when you look at our US ETFs, the initial flows were completely direct. But over a period of time, you had wealth, advisory, et cetera, sort of jumping in and having an allocation to our ETFs. Now, if I take a step back, and if I take a look at like traditional ETFs as well, it's generally a deeper market in the US, and that's been the case for traditional ETFs as well. It's nothing to do with crypto in comparison to Europe. And you see that dynamic sort of rhyming with crypto ETFs as well, where the structure of the market, the uniformity in like taxation, regulations, the post-trade infrastructure, et cetera, which is there in the US, it tends to be a bit nuanced, it tends to be a bit different in Europe, which sort of has a bearing on how the wealth segment sort of looks at it as well, how immediately it sort of jumps into the product, and that's what sort of differentiates flows in the US versus Europe. Yeah.
But I would like to add that in Europe, investors have more choice and better choice. So for example, in Europe, we have liquid staked ETF product, liquid staked ETH, ETP product, which is 100% staked all the time. And staking reward adds to the reward that investor gets from just price change difference. In US, that is still not possible. And in the US, staking products are still going through massive hurdles. So what we have in Europe, I always say that I'm a very proud European, because what we have built out here is really good for investors. It's just that the marketing machine is bigger in the US, and I was actually very glad to see the success of the products in the US, because it opened the investors' eyes here in Europe.
I love this European pride here. One difference is that I think in here, they're technically crypto ETPs, right? In a lot of cases, they're not ETFs because of like restrictions around usage. Does that make a difference at all?
It's purely branding. So I always educate investors that physically backed products in Europe are the same as physically backed products in the US. Because if there is a Bitcoin product in Europe or Bitcoin product in the US that are physically backed, Bitcoin is held securely in cold storage accounts at the custodians. So for an investor who wants Bitcoin exposure, investing in the local product is usually a better choice because of just ease of access and ability to trade on exchanges that they are closer to, that they are set up with, that allow them to trade in their local currency.
Yeah, if I can add here, we use both the European ETPs and the American ETFs. And it is true, the European ETPs have a lot more choice. They have staking, they have a lot more coins. There are like 50 coins which are tradable via ETPs in Europe. But the liquidity of the US products is actually a lot better. So a lot of the trading we do is actually in US hours, and we can see that prices are a little bit better in the US in size. So definitely we can see this difference between these two markets.
Nadine, is there anything that institutional investors are still worried about when it comes to crypto ETP custody? Like, kind of what are they looking for?
I think that even though you're investing in an ETF, you have to consider the underlying risks. So that the ETF still needs to hold the asset directly with the custodian. There are things that investors would need to look at in terms of what sort of liability there is for asset loss, and also those underlying risks, that operational risk that still exists, as well as looking at legal aspects such as bankruptcy, remoteness, and so on. So I would say that there's good custody solutions in the market already today that are being filled by a number of large crypto custodians. I think in the future we'll see qualified bank custodians come in, and we've already publicly announced that we're looking to offer that direct custody of crypto in the US market this year. I think that is really important because safety and soundness of the underlying asset is absolutely crucial, even for underlying ETF products. And so coming back to having to manage not only heightened risk because it's a bearer instrument, so you lose that asset, something goes wrong with the key, it's gone. So custodians are starting to move from the traditional sense of securing an asset in a CSD to actually managing the keys that are associated with that asset. And that comes with cybersecurity risks and being able to securely manage those keys during the creation of them, the transaction signing process. And we build that into our bank-grade cybersecurity framework and into very secure data centers. So actually the role of a custodian is shifting quite dramatically with digital assets. And it's not just crypto, but in the future, that will roll out to digital securities and other types of digital fund products. So even as a custodian, we are saying, well, crypto is an asset class, and we need to support our institutional clients who are launching ETFs, who are looking for investment and exposure. But also we need to then expand that as fund managers start to roll out traditional fund products, or if that fund manager brings crypto into an existing traditional fund. So as a custodian, we need to, we're thinking that we need to be able to provide that one-stop shop and that single operating model to support all types of asset classes.
If I can add, Nadine makes is it better now? Nadine makes a key point. Firstly, just to go back to the question that you asked in terms of custody, right? So I think we need to sort of put it in context of ETP demand comes at, I mean, it's contingent on the asset demand itself. An ETP or an ETF is essentially an access product. So if there is demand for the product from an investor, broadly a professional investor, I think they look at it, the primary consideration for an investor is where it fits in their portfolio, how it impacts their portfolio, what kind of correlation it has on their portfolios, where it sort of, what are the risk and return drivers of the asset itself. Once that hurdle or that question is passed is when the other considerations in terms of operating aspects sort of come in. And when operating aspects come in, like it has been pointed out earlier, like the ETP ETF structure is not new. It is familiar, it is trusted. Investors have used it as a structure in the past across like the myriad ETFs we have in the market today. The additional nuance comes in from crypto assets themselves. And that's where I think getting the familiarity with how ETPs, ETFs sort of custody their assets, albeit from an investor perspective, you're not taking the additional sort of responsibility of holding it yourself, but it still sort of has to go through risk management sort of frameworks, functional groups inside institutions that are engaging with this new sort of paradigm. And it's interesting, Nadine brought up this point, is that the way we look at it from a Blackrock perspective, we look at digital assets across 3 streams. So there's crypto assets, there's tokenized assets, there's stablecoins. And ultimately, if you look at this market infrastructure itself, it's sort of 2 big universes here, right? One, you're taking an alternative asset class, crypto, and you're putting a traditional finance wrapper around it, which is ETPs, ETFs. The other, you're taking a traditional asset, could be money market funds, could be anything else. You're putting an on-chain wrapper around it. Clearly, as has been pointed out, one universe is way bigger than the other today in terms of flows, in terms of volumes, in terms of assets held. But where one universe and the adoption of one universe is sort of benefiting the other universe almost indirectly is the point that Nadine mentioned, where every participant that's engaging with the ETP or the ETF today, could be a bank, could be a broker-dealer, could be a wealth advisor, is indirectly getting educated, getting aware of what the intricacies are of holding a digital asset, although they might not be doing it together, like along with it. And that's where it sort of helps growth of the overall market.
I think that's an interesting point because we've been talking a lot about how the good thing about ETFs is you get to invest in crypto within a framework that you're familiar with, and you don't have to worry about all the intricacies of the blockchain and all that. But I mean, is that really happening kind of in terms of what you're saying? Like, are institutional investors who are now kind of happily investing in crypto through ETFs, are they actually going to start learning about the crypto ecosystem and the blockchain, and kind of are they going to go into the crypto native world?
I can see it because I'm traveling across Europe discussing 12 different exposures with institutional clients. For the majority of them, Bitcoin is the first step in, and most of them will be happy invested in Bitcoin and will view Bitcoin similar to gold and not worry too much about that. But for investors who have been invested in this asset for a few years, they start asking me like, okay, what else is there? What is the difference between ETH and Solana? What other blockchain should I consider? Should I look at XRP? Should I look at Stellar? Should I look at Polkadot. So they start exploring. And for most of them, I say that unless you have somebody like me in a house who's able to spend all of his or her time researching different blockchains, then for most of you, the most sensible approach is to go with a broad crypto basket. Because if you want to have store of value, which is Bitcoin, and then you want to experience growth that will come from stuff being built out on various blockchains, to capture that growth, basket is the way forward.
So from my perspective, there is a lot of possible innovation coming to the ETF space over the next few years. Because right now, ETFs and ETPs are just Delta One products giving you the easiest thing, which is like linear exposure to an underlying, like a crypto asset. But there is so much more to do in DeFi. Like, for example, there are DeFi strategies, there are like lending, there is crypto collateralized lending, there is staking, there are a lot of different things in DeFi which you can do via DeFi protocols, Morpho, Aave, Uniswap, Pendle, Maple, like a lot of cool things which institutionals cannot really access right now. Because Nikhil was talking about these two universes of TradFi and DeFi, and these two universes are very much separated right now. There is a big chasm in between that is stopping like institutions to really come in. And sure, ETFs are just a first bridge that's allowed some of the institutions to jump into the easiest thing that you can do in crypto, which is get Delta One exposure, but everything else is still precluded from institutions. So I think, like, if you're a crypto builder out there, there is a pretty interesting space to build new things, new products, and this requires TradFi and DeFi actually working together to get there, to merge these two universes and really unlock the benefits of crypto as a technology within the financial industry space.
I can chime in if we have time. Yeah. So I think, like, to go back to your question, right? I think it's necessary to decouple the discussion we're having here today, which is this is about ETFs and how investors view crypto as an investment asset class. So then it's almost like, do I need to know the intricacies of how the blockchain works? Ideally, no. But I do need to understand how the asset that I'm looking at sort of fits within my own portfolio in terms of its correlation, risk, return, reward characteristics, and sort of how it sort of enhances or sort of neutralizes my portfolio. That's typically what investors look at. And some points that were made earlier, Bitcoin typically has been looked at as an asset of one in terms of what it does to the portfolio, in terms of how it provides, the fundamental characteristics of Bitcoin sort of play a role in terms of how investors view it, in terms of how it could be a hedge against inflation, monetary debasement, geopolitical uncertainty, although recent price performance may not be reflecting that. But that's how investors view it. And to that then, like, where their considerations sort of come in is if we are getting access to this portfolio in a way where we don't need to take the burden of wanting to sort of select a vendor, select a safekeeping custody mechanism, keep the keys, etc., what they would definitely need to do is understand how their service provider, in this case us, as an ETP, ETF issuer does it, but they themselves don't need to really get into the intricacies. They just need to sort of understand that at a broad risk-managed level, it's done at a level that can give them comfort, and it can give their investors comfort that the assets are in good hands. So that's the limit of what you would want to know from an investment asset class perspective.
Yeah, because if we look at the ETF product mix right now, it would seem like it's very concentrated in, your kind of BlackRock's, Bitcoin ETF, for instance, or kind of at most maybe an ETH ETF. I mean, in terms of like the future product mix, do you see inflows going at all to kind of any kind of ETFs beyond, one just tracking Bitcoin or ETH? And are we really going to see more launches kind of beyond those?
Sorry, call Blackrock. So at the moment, you're right. It's completely contingent on client demand, right? So even our current ETPs are a function of what our clients wanted exposure to, and our current ETPs are ETPs and ETFs are almost. They rhyme with the current market capitalization within the cryptocurrency space itself. Bitcoin and Ethereum form like 70% of the market cap. Bitcoin the highest, around 60%, and the ETPs that we have and generally are in the market sort of rhyme with that kind of volume base. In terms of other ETPs, other cryptocurrencies, it depends on what exposure clients want and why. And thereafter, we put an overlay of like, what's the liquidity profile, what's the maturation, what's the ecosystem right now, what the ecosystem can be, and like what role do what participants, including us, need to play for that ecosystem to grow. And that sort of defines or determines what products come into the mix. But at the moment, it's BTC and ETH.
And I was going to say that we, as WisdomTree, we already have 12 different products, 8 single coin and 4 crypto baskets. And all of them were launched because there was client demand for this. And actually, I published Crypto Monthly report that's posted on WisdomTree website, where you can see flows into various exposures. And for example, Solana and XRP have attracted significant flows. And there are a few other altcoins that are gaining traction. And in addition to this, there are also many structured products now. Now they have most of the AUM in the US. But people who want volatility control or drawdown protection, there are crypto products, crypto ETFs, already structured to deliver that. So there is a lot of innovation. And I see that Bitcoin is very much first entry point. And once people see that it's delivering for their portfolios, they start saying, okay, what else is there? What else should I consider? And then various options are available to them.
And I'd add, when you're looking at institutional investors, I think market access is extremely important because, as you said, Bitcoin's the first product, and they don't want to deal directly with the infrastructure or the direct risks involved in that. I think once they get into these access products, then it will start to expand. But we understand the complexities of that market risk, and we provide investors with access to different markets around the world. They don't want to deal with that infrastructure risk. So I think in terms of the products and then having the right infrastructure, custodians, data, risk management, those things need to come in as then they start to progress from Bitcoin as an asset to the broader range. But we're certainly seeing demand from our institutional clients for investing more broadly than just in Bitcoin. And even certain wealth managers who are sort of at the forefront of it, looking at broader ranges of access products to, top 10, 15 coins.
Yeah, so I come from the traditional equity world. I was an equity trader before entering crypto. And when I look at crypto, I actually like to look at the fundamentals. And there are a lot of coins or tokens which actually have a lot of cash flows and a pretty reasonable valuation to those cash flows. And these are not necessarily within the top 5, 10 crypto assets by market cap, where a lot of the products are concentrated right now. And they're not necessarily in the blockchain space. They're not layer 1 or layer 2 blockchains, but they are applications building on top of blockchains, some businesses. Then, of course, a token is not exactly the same as an equity product, but a lot of tokens look like equity products because they are there are some profitable businesses behind which generate these cash flows and bring those cash flows back to the token holders, either via staking or a buyback and burn program. And so I would love to see more, definitely more products within the crypto space that go beyond the top 10 or 15 names. In Europe, we already have some. But a lot of the names with strong fundamentals still don't have listed ETFs or ETPs, and I think it would be great to see them in the future.
But could we see some like ETP liquidations? Because if you look at the market right now, there are ones that have like tens of millions of dollars in assets. Like, is there a size kind of below which it's sort of not very profitable to run an ETP anymore? Do you think we're going to see a wave of liquidations?
So for my Crypto Monthly, I monitor the new ETP launches around the globe and the ETP closures, and ETPs do close down. So if the client demand is no longer there, some issuers say, okay, it's no longer worth running the product. But I don't think it's an issue, because all issuers, ETP issuers, irrespective of asset class, they manage their product ranges, and if they do not see demand for a specific exposure, then why have the product?
And if we kind of go back to the price action for a moment, it's kind of interesting because we've seen gold surge to records lately. It's kind of come back down, and the same with stocks. And it would seem like recently it's been kind of exactly the kind of environment where, in terms of the macro narrative, that crypto should be doing well, but instead we're seeing the opposite. I mean, is that changing the case for institutions to invest in Bitcoin?
Absolutely not. So what happened at the end of January was 10th by size liquidation event. So number of leveraged positions were flushed out, and those were forced liquidations. And last year, on the 10th of October, we had the largest liquidation event, which liquidated over 19 billion. So these types of events happen because crypto market is highly leveraged. And during illiquid weekend hours, even small price move can lead to forced liquidations. But for most investors, institutional investors, they need to disregard that. And I've published some research on this topic, showing that after a large liquidation event, prices tend to correct themselves 6 months at the latest.
I think I alluded to this earlier. Like the fundamental characteristics of Bitcoin as an asset and the conviction behind what people have on ETH as well, though those haven't changed. So if you think about Bitcoin, just take it for an instance, it continues to be a scarce asset. It continues to be portable. It continues to be independent of any monetary sovereign authority. These are the characteristics that led the markets to sort of assign almost this hedge type of a characteristic to it, where it said it's basically hedging you against geopolitical uncertainty, inflation, monetary debasement, etc. Has it behaved that way in the past sort of whatever months? Hasn't. And Dovile pointed out, like the 1010 event was kind of a sort of an idiosyncratic risk within the market itself, which sort of led to a high-scale deleveraging, both for speculators and for original holders of the asset. Liquidity was constrained, and thereafter, almost Bitcoin started behaving in its own way as compared to sort of equities, public markets, gold, etc. One thing that hasn't sort of helped this market in general is this whole narrative, self-inflicted mostly, of whether Bitcoin is a risk-on asset or a risk-off asset. What we do believe, what we do agree, that Bitcoin is a risky asset. So it does have volatility, it does bring volatility into your portfolios, but the moment you start putting it into the bucket of like a risk on or a risk off, you start introducing a narrative, start trading the asset through macro factors, through factors that shouldn't really have any kind of effect on the dollar value of Bitcoin, because it really comes in from your fundamental conviction of what does the asset fundamentally give you as an asset class itself, and how does it behave within your portfolio? Because your investor portfolio could have like a multiple number of assets with which the asset may be correlated, may be uncorrelated. That's the thing to be looked at rather than every other macro factor and sort of bucketing it against or bucketing it with other risk on and risk off assets. That's, I guess, what's...
Yeah, 100% agree with you. Definitely the digital gold narrative was something that pushed the price of Bitcoin in the possible market, and I agree that nothing has changed. Like Bitcoin is still, I believe, the only candidate, the only credible candidate for that role of digital gold. But this is true in theory because of its characteristics. It's not really true in practice. Like Bitcoin is not behaving like digital gold, not at all. It is behaving like a risky asset. So, of course, in a portfolio construction, a portfolio allocation, it does matter when you have positive correlation to equities, and in this phase, underperforming equities, then you need to take into account that. You're not hedging your portfolio by buying Bitcoin effectively. Not to all these risks that we're seeing right now. So when there is trade tensions, geopolitics, a lot of these risks come into the market, then Bitcoin sells off, Ethereum sells off even more. It's particularly fragile to these geopolitical trade news, trade tensions. So yeah, crypto is definitely not like a safe haven asset. It did have some of this maybe like 2-3 years ago when some of the regional banks in the US had some issues. Bitcoin rallied because people valued having like zero counterparty risk, and so they bought Bitcoin then. So there have been in the past like periods of time where Bitcoin behaved like a risk-off asset, actually hedging portfolios, but this is not the environment where we are in. And Bitcoin at the moment is a risky asset. It's behaving like one, and we need to take into account this.
Great. I think kind of time is running out here. Kind of any parting thoughts? What's sort of our takeaway here?
The takeaway is every single one of you who manage portfolios, I encourage you to run the analysis and see how much crypto would be appropriate for you, and then decide how you want to get that exposure, and hopefully via exchange-traded product wrapper, but then have steady, clear mind. If you decide to allocate 1% and stick to quarterly rebalances, just do that.
I mean, it does kind of feel like institutions in general move really slowly. And so maybe once they've gotten into crypto, it will take them a while to kind of decide to get out. Plus, if they want to get out, then Dovile will be there like calling them. That's sort of my conclusion here. So thank you very much, everyone. And please kind of join me in thanking my panelists.